HDFC Nifty100 Low Volatility 30 Index Fund. Will investing in this fund help add value to your investment portfolio? The returns you get from investing in this fund will help in your wealth accumulation process or not. Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial and investment decisions to reach your financial goals in a faster and smarter way. So as this fund is an NFO, let us first understand the basic key features of this fund. So as an NFO, this fund opens on 21st June 2024 and is open until 5th July 2024. And some of its key features are it's open-ended fund type and it has Nifty100 Low Volatility 30 TRI as its benchmark, and it belongs to a category of equity large cap. And the fund managers of this fund are Mr. Nirman S. Morakhia and Mr. Arun Agarwal. And the minimum application amount needed to start investing in this fund is just 100 rupees, and the riskometer involved in this fund is very high. The primary investment objective of this fund is to generate returns for you as an investor before the fees and expenses with the performance of the Nifty100 Low Volatility 30 Index. So, which can be subjected to tracking error. But their investment objective is to mainly correspond to the total returns of the securities represented by the underlying index. So the investment strategy for this NFO is that this scheme is a low-cost smart beta index fund which tracks the Nifty100 low volume 30 index passively. So by tracking it passively, it aims to achieve a return which is equal to the underlying index while trying to minimize the tracking error. So now we are going to take a look at the top 10 holdings present in the Nifty100 Low Volatility 30 Index Fund. So the top 10 companies present under this holding are Hindustan Unilever Limited, ICICI Bank Limited, Britannia Industries Limited, Asian Paints Limited, ITC Limited, Ultratech Cement Limited, Marico Limited, HDFC Bank Limited, Sun Pharmaceuticals Industries Limited, and Reliance Industries Limited. So the weightage percentage given to these holdings ranges from 4.45% to 3.50%. And if you look at the sector representation, this Nifty100 Low Volatility 30 Index Fund represents sectors which are FMCG, financial services, healthcare, consumer durables, automobile and auto components, information technology, power, construction materials, oil, gas and consumable fuels, construction and chemicals. And the highest weightage are the three most highest weightage given to FMCG, financial services and healthcare, and the lowest weightage are given to oil, gas and consumable fuels, construction and chemicals. So this is the sector representation involved under the Nifty100 Low Volatility 30 Index Fund. So if you look at the returns as on 31st May 2024, it has given a yearly return of 3.91%, and 1 year it has given 29.41%, and in 5 years it has given 16.81%, and since inception it has given you a return of 18.15%. So from this we can see that in long term it has the potential to give us a growth with minimal volatility. To better analyze the HDFC Nifty100 Low Volatility 30 Index Fund NFO, we are going to analyze the pros and cons of investing in this fund first. So as we can see by analyzing the sector representation and that is available under this NFO, that this fund invests in a diversified portfolio that are likely to deliver long-term growth with minimal volatility, and also invest only in companies that generate economic value. So if you are an ultra conservative investor who does not want to add more risk to your portfolio but looking to add passive investments to your core equity portfolio, this NFO might be suitable for you. And also if you compare this with an actively managed fund, the returns from this fund are relatively stable with less volatility. So this fund, as this is a passive managed fund, it is also free from fund manager bias. And as it represents low volatile companies generally mean companies that are relatively stable businesses with strong fundamentals and business models. So as it is managed passively, it is expected to have lower expense ratio than other actively managed mutual fund schemes. So these are some of the advantages you might get by investing in a fund like HDFC Nifty100 low volatility 30 index fund NFO. Now we are going to take a look at the cons of investing in a NFO like HDFC Nifty100 low volatility 30 index fund. So as this fund predominantly invests in equities, it's not suitable for a short-term investment, because generally if you want to invest in an equity related instrument, it's better if you invest for a long-term investment, because in a long-term period the market cycle would have gotten completed and would have got to give you potentially better returns with stability. But in a short-term investment, the market cycle will be highly unpredictable, where it will go through a period of negative returns, low returns, even a period of where there will be no returns. So if you're looking to invest in this fund for a short-term investment, then it might not be suitable for you. For if you're looking to invest in it for a long-term period, then it might be suitable for you. So in a short term, it's very risky, and also as this is an index fund, it may underperform its index due to certain factors. So it's not a guarantee that it will track the index perfectly. Definitely it can also underperform due to certain factors, and this fund will not be able to deliver market beating returns. It can at most deliver returns that match the index, but not something that can deliver the market beating returns. So that's also a con if you look at it. And based on the market outlook, the fund cannot change the allocation dynamically as like a actively managed fund. As this is a passively managed fund which tracks the index, it will not change its allocation dynamically based on how the market is performing right now. So as an index fund, they also do not do any analysis on the underlying stocks and check the soundness of the company in which they are going to invest. Like for example, if you take an actively managed fund, the fund manager will look at all the possible factors for the underlying stocks and see what is the soundness of the company before choosing to invest. But as an index fund where it's tracking passively, it's just going to copy the index entirely, not going to pick and choose apart the index individually, right? That's also a con in this fund. And as an active fund, in comparison, it can take calculated risk by analyzing all stocks and choosing the best. But here we are not able to take that kind of calculated risk as a passive fund. So the major drawback of an index fund investment is the tracking error, since it may not perfectly track its index. And also as an index fund, it's not flexible and will not be able to take any course corrective measures during the correction or market crash, unlike a actively managed fund. So this is something you need to consider before choosing to invest in a passive fund NFO like HDFC Nifty100 low volatility 30 index fund. What is the final takeaway? So the final takeaway from our analysis is that this NFO might be suitable for an ultra conservative investor who's not willing to invest in actively managed funds. But even then, as an NFO, we do not have the complete track record in our hand right now. So if you do want to invest in a fund like with the index like this, there are other similar index funds with that have a lower expense ratio and even a lower tracking error compared to this NFO. And also you can even choose to invest in an actively managed fund if you want to take a little bit of risk, because they might have the potential to deliver you higher returns compared to this one. So if you are an investor who's expecting dynamic fund management and looking for investment that can beat the market, then you should definitely avoid investing in this fund, because it might not be able to give you that kind of returns or even a dynamic fund management. So if you want to invest in this fund, it's better if you consult with your financial planner, because a professional financial planner will be able to look at all kinds of factors, from your investment objective to your risk profile to the overlap ratio between your investment portfolio and the investment portfolio of the fund you want to invest in, and how much asset allocation you need to give to each kind of fund you want to invest in. They will look at all kinds of factors and will be able to create a perfect investment strategy, and will able to suggest investment options for you that will help you reach your financial goals in a more faster and smarter way. So it's better if you consult with your professional financial planner in the long run for your financial security in the future. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, We also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.